Welcome, it's Blazsik here, Logos and Markets. In this video, we're going to look at the Sim Excel sheet and we're going to go over a call contract, a call option. Again, once we get into option strategies, you have to know how to write a call. You have to know how to do a put, and now we can see the different strategies. Go to Logos and Markets website under Sim Finance. You can find option strategies. All these Excel sheets are accessible free for anybody to view. Or below this video, you can see the Excel. On some platforms, you can see the Excel sheet right below. So let's get to it. Here's our call. Here's the strategy, just a couple notes on it. If you see OTM, that's out of the money. If it's ATM, that's at the money. If it's ITM, that's in the money. So this is going to be our call strategy. So I'm going to do exactly what we did before in the introduction. I'm going to do a $100 stock price, very similar to what we did with the put. And as you can see, the stock price, $100, that's the spot price, the current one, what I want to know. The strike price in this example, it's a right to buy. That's a call. I'm saying we could buy it at 110. Next, how much is the contract? Well, that's going to be $3. That's how the seller is making money. They're selling the contract. Now, they're going to have greater risk because they have to make up the difference if it goes up to 200. But they are selling it. And then last, I want to know the increments of that stock price. I'm going to say it's going to go at 5%. And again, you can do anything you want. You could say 2%. You could say whatever. I'm going to say 5, and you can see increments 5, 10, 15 are negative, and there's the continuous compounding function that I put in there for stock price. So what we're going to do is we're going to do our function. We want to know how to plug this into Excel, and we're going to do a long. So we're going to purchase the call, and I want to see what the graph looks like. Just so you know, the graph could look a little weird. You might have to move Excel like this. It happens to me. And then you'll see the error pop up and it'll be correct. So let's look at the current stock price of 100. We want to look at if we purchase the call. Well, if we purchase the call, first thing I want to think about, that's costing me negative $3. So I'm going to select the premium. I'm going to hit function F4 because I want to freeze that or make it an absolute cell reference. Don't want it to move. I'm going to say plus. Remember, anytime you buy a contract, that's going to be the max function. I want whatever, because I am the buyer of the contract, which means I'm the one who decides if I want to exercise the contract, which means I'm only going to exercise it if it's a positive value. If it's negative, I want whatever is greater, my function or 0. I'm going to let it expire. So the first thing I'm going to do is hit 0. So it's whatever's max, whatever's greater, 0 or, now think about a call. I have a right to buy at 110. If it goes to 200, that means I made 90 minus 3. That means the stock price is 90, so it's going to be the stock price minus the strike price. Function F4 in the strike because I don't want that to move when I move it up or down, and I want the stock price to move up or down. That's going to be a negative $3. If it's 100, right? It didn't go up to 110 yet. So let's look at out of the money. So I'm going to drag that up. If it's out of the money, that means I'm going to let it expire. It should just be a loss of $3. And that's correct there. And now what we want to look at, I'm going to hold down shift, do arrow, the down arrow down, and it just shows really quick. So if it hits at 105, I did not exercise it. 110, now I can exercise, or I'm sorry, 111 with the percentage. So I do exercise it at 110, which means I made $1 minus 3. I'm still down negative 2. And then if I go all the way to 135, see that graph, I have to go up, and then you can see my dotted line there. I don't know why it doesn't do that. So as you can see, if it goes beyond right here, let's think about what is our break-even point for a call option. Well, 110, I could buy it. Well, the stock price must get to 113, right? 113. So if I type in 113, that's the break-even stock price because I could exercise at 110. It costs me 3. So if the stock hits 113, I'm going to break even. It's the same as the buyer and the seller. So now let's do the seller. Let's look at the spot price. I'm going to go equals. Right away, you want to think about the seller is making the premium. That's going to be positive. I'm going to function F4 because I want to freeze it. I'm going to say plus. And then remember, anytime you sell a option contract, it's going to be a minimum. It's going to be a minimum function. I'm going to hit tab. Now you want to think about, they're not making. And the reason why we're doing minimum, just really quick, is because it's the opposite of the buyer, which means I'm only going to pay out money if the buyer exercises it. And if you see, if it's out of the money, they're not going to exercise it, which means I should be $1. So I want whatever is less, right? I want if it's negative or 0. I don't want a maximum function. I want a minimum because I am the seller of the contract. So first thing you want to do is hit 0. So the max and min both have a 0. And you want to think about, it's not necessarily their profit loss right here. It's the function that they have to pay out to the buyer. Okay. So the buyer's function was stock price minus strike. So that means the seller is the opposite. It's the strike price, function of 4, minus the stock price. Now I'm going to close it up. So it's correct. So you see that right away. The buyer is down -3 and the seller is positive because they should mirror each other. So that looks like I did that correct. So let's drag this down and see. I'm going to go down to that one. So it's correct. And if I go one more down, this should show a +2, right? -2 on the buyer, positive on the seller. And then let's go all the way down. It should show a -22, which it does. Again, I'm going to scroll down, go back up. The graph does that to me. I'm not sure if it did to you. And there is our profit loss for the buyer and the seller on the call contract. And again, you can go here, select it. I don't think this is available for the Mac, but on the PC it is. In the Mac, it doesn't pop up here. You have to go find the filter. I'm going to hit the filter button, and I could take out the purchase or the sell and hit apply and just see what it looks like by itself. So just to show you real quick, I'm going to take off the sell. I'm going to hit apply. Now you have a little better look of the call, and then you could change things. I'm going to change that increments, let's say 10%, and you can see what it looks like. All that means is we're looking at a larger stock price. It goes all the way to 182. So there's a 182 and there's 182. Now I'll just show us real quick. You can do 100% if you wanted to. Look how funny that looks. It's so small there, the cost, because we're going all the way to 40,000 if you do 100%. So it's going by 100% each time. But just show you have a lot of different options. You can do one and whatever. And if you want to go back, you got to hit filter. I'm going to have select all, hit apply, and we have the contract there. I mean, you could put that into any copy that if you want to put that into a report you're doing or anything you want to use. Free to use my Excel sheet on that regard. There you go. So that is a call, and you can change everything up, stock price and all that. Now you have to know the call, you have to know the put in order to understand option strategies. Again, this is Drew Blazsik with Logos and Markets. You get all Excel sheets on logosmarkets.com website. Thank you.